check in now where we're likely to open in this morning's trade. SPI futures sitting up in the green, almost 1% higher. And for more on the day's trade and what to expect at 10 a.m, James Gerrish from Shaw and Partners is joining us now live to tell us more. James, great to have you on this morning. It's looking like a pretty strong open.
Yeah, good morning to you guys. Yeah, a gain of 71 points for the SPIs, obviously keying off a weaker Aussie dollar overnight and lower bond yield. So that's obviously supportive for our domestic equities today. So, that outlook around the RBA has changed a little bit, that, versus where the market was expecting rates to go. So that's why we've seen a pretty strong move on our futures market this morning, guys, despite, commodities being weaker overnight and our banking ADR is softer over in the US.
James, are you reconsidering your portfolio at this point, given what we heard from the RBA yesterday, and I guess when rates are likely to rise?
Yeah, I don't think anything really dramatically changed in terms of portfolio positioning for us yesterday on the back of what the RBA suggested. The RBA was saying that interest rates wouldn't rise till 2024. We hadn't factored that in. The market, along with us, had been factoring in rate increases before that. They're now guiding sort of more towards 2023, but it's going to be more data dependent. The yield curve control that they had in place on the 3 years, that clearly wasn't working. The market was positioned against that, and the RBA simply couldn't stand in front of those market forces. So nothing that came out yesterday sort of changed our view of the market, particularly around, I've got a view that inflation is rising, interest rates are going high, you need to be holding inflationary hedges in portfolios, etc. So that certainly hasn't changed based on yesterday's rhetoric from the RBA.
Yeah, what are some of those inflation hedges that you do hold at the moment, James?
So, the clearest inflation hedge is energy. So I know it's been a little bit soft in the last week or so, but energy is featuring in portfolios. That's a clear inflation hedge. When you're holding debt securities, you want to be holding floating rate notes. So hybrid securities listed in Australia over and above fixed rate bonds is what you want to have. Commodities are obviously an inflation hedge as well. Some have been doing particularly well, some have been doing particularly poorly. So there's a lot more supply and demand dynamics playing out in that part of the market. And finally, sort of stocks with pricing power. Obviously, with inflation going up, prices go up. You need to be able to raise prices to offset that inflationary impact. So you need to have companies with dominant positions. So one of the last stocks we've bought was ResMed into weakness. We've added that to our growth portfolio. That's a company that's got clear pricing power. So there'd be examples of what we're doing around our macro expectations.
James, from energy into materials, iron ore coming off again. Where do you see that at the moment and the prospect, particularly for those iron ore majors?
Yeah, it was an interesting session yesterday, actually, Andrew. So iron ore was limit down in China, which is down just shy of 10%. So they stopped trading there. But if you look at our iron ore miners, they only dropped sort of circa 2.5%. So you'll often find that stocks lead the underlying commodity. The fact that I know they were all weaker yesterday, and I'm not trying to put a positive spin on a weak session, but what you often see is stocks sort of outperform the underlying commodity, and that's a sign that a turning point is in play. Iron ore prices got to, they hit $90 a tonne in some markets. So that's often, they've been there before and they've bounced really hard from that level. So $90 is also a point of, where some producers come offline. So some of the higher cost producers, even stocks like Mineral Resources, it becomes a struggle at $90 a tonne. So obviously Chinese production has a cost base higher than that. So at $90 to $100 a tonne, I think that's about right. I think that probably the next move is on the upside in iron ore, and I think iron ore miners showed that with their relative outperformance yesterday.
James, before you go, let's switch gears. Net Wealth making a play for Praemium yesterday. What are your thoughts?
Yeah, it's been an exciting sector, the independent platform space. So obviously they're all creaming it. They're all getting huge amounts of FUM coming, or funds under administration, I should say, FUA coming onto their platforms, and they're out there trying to do a big land grab. So we saw Net Wealth make a play for Praemium. We've seen recently Hub make a play for Class. So it's all happening in that space. I wouldn't expect the Net Wealth deal for Praemium to get up. The board has come back and said that it's too low. We'd echo those thoughts. We think it's worth more than the $1.50 or thereabouts they've lobbed. The value, the deal that they've lobbed is worth at the moment. And you might even see Hub come into the picture here, or an overseas player. So for mine, we're a holder of Praemium. We're actually a holder of Hub as well, which is obviously fell yesterday on the back of this news, but we're a holder of Praemium, and we're going to continue to hold given the expectation that there's going to be another more attractive bid, and that what Net Wealth has done is undervaluing the stock at this point in time.
James, good one. Enjoy the day. Thanks for joining us on Shaw and Partners.
Have a good one, guys.